These two guys met at college, created a hedge fund, and within 10 years had tanked the entire crypto market and were left staring down the barrel of a $3.5 billion bill. Our story starts with two guys who met at college, Su Zhu and Kyle Davies, both pretty regular guys who had regular finance careers. They got a good education at an elite Massachusetts boarding school, studied at Columbia, and then learned the ropes trading derivatives at Credit Suisse. So far, fairly normal. How can these guys end up with a business that crashed the entire crypto market? Well, it all starts with a little risk. In 2012, that fateful year when the world was supposed to end, our two heroes did something unusual for a couple guys in their mid-20s. They started a hedge fund called Three Arrows Capital, 3AC, which, like most hedge funds, essentially is a pool of investor money used to trade in liquid assets and hopefully get great results. Yeah. We'll get to those results. Based in the British Virgin Islands and licensed in Singapore to manage other people's money, 3AC wasn't big, wasn't flashy, and had a simple but unexciting business model. Find price gaps in emerging market currency derivatives and exploit them to make money. Do this enough times, you'll make a decent profit. And for a few years, this satiated them. But then 2016 happened, and the world of digital assets started to rear its head big time. To most back then, this world of cryptocurrencies was exciting, intriguing, and new, but to Zhu and Davies, it was something much, much more. It was an industry that was emerging, vibrant, and full of potential. Zhu himself felt it was an example of Amara's Law, which means that the technology would be overestimated in the short run, but underestimated in the long run. He believed crypto was going to change the world, just like the internet did. People doubted .coms and the internet, but look what it became. But he and Kyle also spotted something peculiar about crypto. The industry was absolutely filled with tons of price gaps. The exact kind of price gaps they'd spent the last few years learning to take advantage of. It was perfect. Money-making time.
That's a bingo.
Speaking of, I need to do an ad real quick. Just stay right there. Today's video is sponsored by KuCoin, who actually just got a strategic investment from Susquehanna International Group. This is huge. The money's going towards KuCoin's expansion and hiring plan to improve the app and build off of Susquehanna's credibility. And if you aren't familiar, they're the largest stock and options trader in the US with over 80 billion in assets and key partnerships all around the world. So as you can guess, KuCoin is pretty stoked about their future. They'll be linked down below, and if you use that link, you'll get a $15 trading bonus when you trade just $100. So 3AC got into the crypto game and started making a major name for themselves. Their strategy began by trading in Bitcoin and Ethereum derivatives, but they soon developed a nice, well-rounded portfolio. But more importantly, they developed a knack for borrowing money from all corners of the industry. And this part is crucial to understand. They were borrowing so much money and using that money to invest in projects that they liked, which meant they had a massive exposure in the crypto market. They borrowed from huge digital asset lenders, the wealthy, and crypto brokerages. They became so reputable that Chase and Bank of America helped them with brokerage agreements. Doors to decentralized finance projects were completely open to them, and slowly but surely they gained an enormous amount of leverage in the space. Eventually, 3AC, our little hedge fund that could, grew into a $3 billion GigaChat giant of the crypto world. And Zhu and Davies always described it in the same way. All 3 billion of it was theirs. Like I said, GigaChads.
Do it!
And their Twitter personas backed it up, where they claimed traditional investing was for boomers. I know, what a scorchingly hot take. Soon, they were pretty much the go-to guys in the industry, but it wasn't all pretty. While they were brokering deals and introductions, amassing fanboys on Twitter, venture investing, and even managing corporate treasuries, some were accusing them of using psyops on Twitter to influence their very own profits. I'll let you decide. Zhu denounced Ethereum. He said he was quitting the currency, which led the price to fall. But according to Nansen Analytics, about 1 month later, 3AC bought about 150,000 Ethereum. But by 2018, Zhu had put them on the map. You see, in 2018, crypto was in bad shape. By September of that year, prices had crashed by 80%, a plunge worse than the dot-com bubble. Naturally, investors were panicking, and there was a lot of doomsday talk floating around. But then in walks Zhu with this tweet: "We will pump off the bottom extremely quickly, leaving most sideline investors stuck in fiat." And you know what? He was right. Crypto rebounded, and Zoo's tweet made him an icon of the industry, which, alongside his hypnotizing new belief system, started getting him real followers. He called it the super cycle, which essentially meant that in the long run, Amira's law would be proven correct in crypto. This technology would help fuel a revolution and create a new internet on the blockchain. Crypto wasn't just here to stay, it was going to change everything. A big idea backed by an even bigger bullish conviction about the market. HODL, no matter what, and you will be rewarded.
I definitely think, if Bitcoin price goes over $1 million, goes over 500K, it's not going to be driven as much by retail anymore. It's going to be driven a lot more by larger players.
Now, this might sound strange, as any trader should know that currency prices can swing all over the place. Why would crypto be any different? But Zoo and Davies were serious. They believed crypto was going to be fine, and HODL was really the only move for serious investors. And you know what? People believed it. Their conviction was compelling, and the accuracy of Zoo's 2018 prediction only reinforced this. They managed to get uncollateralized or somewhat collateralized loans from massive institutions in the industry. Within almost $700 million uncollateralized loan from Voyager Digital, which basically means if everything went wrong, Voyager would just kind of hope that 3AC pays it back. So Zoo and Davies were on top of the world. What could possibly go wrong? Well, when you're on top of the world, the only way you can go is down, and that's exactly what happened next. The downfall starts when a new player enters the scene, and for our sophisticated investors, they're too delicious to resist. The player is the Grayscale Bitcoin Trust, GBTC, and they're pretty revolutionary. Not only do they let people hold Bitcoins by acting as a fund that they can invest in, but at the start, they're one of the only US regulated crypto products, so they rapidly gain attention. In fact, GBTC got so popular that its shares were trading higher than the value of the Bitcoin it was composed of. Insane how hot these things can get. But that's not what made it delicious to 3AC. What made it delicious is that GBTC gave funds like 3AC backdoor access into the trust, which meant they could buy shares at a cheaper price than your average trader. The method here was simple. You purchase your shares using Bitcoin, and those shares are worth more than the Bitcoin you just bought them with. Now this made 3AC salivate with delight. Here was the plan. Step 1, borrow Bitcoin. Step 2, use it to buy GBTC shares. Step 3, use the shares as collateral to borrow more money. Leverage stacked on top of risky leverage. Color nobody surprised by the fact that at the end of 2020, when GBTC last filed, 3AC was its biggest holder. Its position, a touch over $1 billion. Now things aren't all great because there's a clause that says if you buy shares, they're locked up for 6 months. But if you're using the shares as collateral, who cares? You can use that asset now anyways. And if you believe, as Zoo and Davies did, that crypto only goes up, then there's really nothing to worry about here. Well, naturally, the price of GBTC did change. In early 2021, ProShares Bitcoin Strategy ETF showed up on the scene and caused GBTC's price to dive below Bitcoin and keep falling. Not good for 3AC. But remember, they've got their fingers in a lot of pies. One of these pies was decentralized finance, DeFi startups. These startups had a simple enough goal. Take Wall Street, digitize it, and its deposit tracking, trading, borrowing, and insuring functions, but without the regulation, all on the blockchain. It's perfect. But before they could do that, DeFi startups needed as many people's crypto savings as possible. They needed a pitch to get people in. And it was simple. Savings rates on banks were almost non-existent, and safe bonds were bringing in less than 2%. DeFi businesses, on the other hand, were offering depositors double-digit yields. One such DeFi business was Anchor Protocol, offering a 20% return. Tempting stuff. It got me. But to earn that 20% rate, you had to hold UST. UST was a token created by a guy named Do Kwon, king of the lunatics. That should tell you where this is going, but I'll show you anyways. UST was linked to another coin created by Kwon called Luna, which is confusing, but the arrangement worked. As long as Luna had value, UST had value. So what does 3AC do? They borrow and borrow and borrow and deposit.
There's more! I want it all!
By February 2022, they're reaping yields from Anchor, and rather than stopping there, they've put between $200 and $560 million into Luna. And as it went, Luna and UST eventually reached $60 billion in combined worth. They were no joke, except this is where everything starts to go very, very bad for Zhu and Davies and 3AC. Because Luna's price collapses and kickstarts a crypto collapse like... Here's what happened. Luna tanks and 3AC, which was extremely overexposed to Luna, suddenly finds itself facing a problem. It's extremely overleveraged, having taken loans from just about every big player in the industry. And now it can't pay back those loans. They start getting margin called, and the situation just gets worse. Because of 3AC's lack of transparency, nobody, from big whales to small investors, knows how exposed they are. So what do? They start their pants and begin pulling money. This is financial crisis 101. Prices fall dramatically, so people become desperate and get out regardless of whether they lose money or not, and this sends prices even lower. Fear breeds more fear, and it's just a death spiral all the way to the bottom. This is exactly what happened in 2008 with the subprime mortgage crisis, except with crypto, there's a big difference here. In 2008, when banks started going under, there was a big fat central bank ready to step in and save everyone's ass with a bailout. With crypto, not so much. Crypto has little to no consumer protections and nobody's there to clean up the mess. So when the crypto market crashed, it crashed hard and everyone's just out. 3AC started defaulting on loans, causing everyone they borrowed from, like Voyager Digital, and their uncollateralized $700 million loan to tank. This is bad and only sends more of the crypto market into panic as more and more institutions like Blockchain.com, BlockFi, BitMEX, and Deribit all face some kind of exposure to 3AC and generate even more pants shitting. So what did Zhu and Davies do? They met with executives from several crypto exchanges to discuss the possibility of a bailout, the classic Wall Street play. It's never failed before, right? Hey, we screwed up our gamble. Help us. Please? Anyone, please? Sadly, it doesn't work out, and the exchanges just essentially tell them to take a hike. And is this really surprising? The crypto market is currently imploding. The problem in the crypto space is value production. Many tech companies have the same issue. If you're not generating profits, then any price that's set is some degree of speculation because we can't easily figure out its true value. If you have a business that profits $1 million a year, we could figure out what that business is worth. But if you have a business with $1 million in revenue but no profits, we'd have a much harder time setting a price. When there's no profit floor to fall back on, prices can collapse and collapse and collapse even further. In other words, Zhu and Davies were victims of themselves here. So how does this story end? Well, Voyager Digital filed for Chapter 11 bankruptcy. 3AC exposures across the industry led to countless investors having their assets frozen and inaccessible, damaging people's lives. The crypto market is in rough shape still. 3AC was ordered to be liquidated, and 3AC was left, when the dust had cleared, with a total bill to 27 creditors of $3.5 billion. A staggering, brutal blow for the crypto market, but a ludicrous achievement for a 10-year-old hedge fund. And as for Zhu and Davies themselves, well, nobody actually knows where they are. They've kind of vanished. I'm serious, no one knows where they are, and so far they've been uncooperative with the liquidators. But there has been some character growth. Zhu, referring to his earlier supercycle theory, which reinforced the premise that crypto could only go up, yeah, he came out and admitted he was regrettably wrong.